When there's a stable trend with consistent retracements, or a more horizontal phase composed of more frequent swing points, we can still look for stronger and more decisive movements, but they'll normally be less clear and much shorter in duration, compared to larger movements that have smaller or no retracements at all. Frequent short-term fluctuations in price can keep the indicator in a constant state of crossing below and above zero. Now here's a case where there's a gap down and the candle is red, leading to less discrepancies with the indicator compared to a green candle. As the gap rapidly gets filled, the indicator rises sharply. This abruptly ends even before price begins to move flatter into a range with more frequent swing points. This is because even though the last few candles are green, they are bearish with their longer upper wicks, and that causes the indicator to fall. Since closing prices are much lower than the highs of the session, and volume has also begun to significantly decline.